So the biggest frustration I think that I find sometimes with people is when I talk to them about those strategies. And sometimes I work with people that are more do-it-yourselfers. Other people want me to do as much as I can for them. And the do-it-yourselfers are like, yeah, I don't really want to do that. But if they don't, they're going to have a lot of taxes later in life they could end up paying.
What have you found to be the most frustrating thing as it pertains to exit planning, capital gains tax, estate tax? We can talk about the 1031 exchange if that comes to mind, or what are the biggest things that people are frustrated when they're exiting, but they feel like, hey, I wish I had a better way to exit. And maybe you can talk about a couple of strategies that, you come to mind that help solve that.
So for me, one of the things that I find is that you run to people that have large concentrated stock positions and things like that that don't know what to do because it's going to cost a lot of money. They have substantially appreciated stock and they're going to pay tax to get rid of it. So strategies to help reduce the tax on that. I have people that have large retirement account benefits in a qualified plan, such as a 401k or an IRA. They have big balances and they don't realize how much tax you can pay on those when you exit, because of the fact that if we get a tax break on money that goes in, we have to pay tax when it comes back out, and those taxes are at ordinary rates. So the biggest frustration I think that I find sometimes with people is when I talk to them about those strategies. And sometimes I work with people that are more do-it-yourselfers. Other people want me to do as much as I can for them. And the do-it-yourselfers are like, yeah, I don't really want to do that. But if they don't, they're going to have a lot of taxes later in life. They could end up paying much higher tax rates. They could end up paying higher Medicare premiums. And I like to think I wrote a blog called How Roth Conversions Can Benefit You, Your Surviving Spouse, and Your Heirs. Because if you think about it, when we're a couple, we're taxed at a joint tax rate. When one spouse goes, the survivor is going to be single. They're going to keep most of the income. One Social Security benefit will go away. If there's pensions or something like that, they may or may not go away. But all the money in the retirement account is going to stay. And so then their tax rate's going to go up. So if we do Roth conversions before that happens, that helps. And then if you're fortunate and you've done the right things have happened with your kids, that money can pass to them at the end, and it can make their tax rate go up. So a lot of these things involve thinking ahead, as opposed to just thinking about the now.
Yeah, no, very, very well put there. I want to focus like a laser on that public stock piece. I started out at Marcus and Millionaire, who will buy and sell multifamily properties. And what we found is that people got frustrated with this 1031 exchange, being that it was highly appreciated assets, and they actually wanted to diversify maybe into some stocks or diversify into some other assets. They weren't so heavily concentrated into real estate, right? And the timing was right to sell, but then they end up having to overpay and buy a property within that short period of time because of the rules for the 1031. Likewise, we've had clients have highly appreciated stock positions, right? And they want to diversify out of it, and they want to sell high, or cryptocurrency, right? And so we've been able to do it using something called a deferred sales trust, where it works for public stock, private stock, cryptocurrency, business sales, real estate, primary homes. And in other words, we eliminate the need for the 1031 exchange, any asset of any kind. And not only does it on public stock eliminate or defer the capital gains taxes, but it eliminates the estate tax without any charity, without any gifting, without any life insurance. So I'm curious, have you ever heard anything like that before, Phil? And what are your thoughts as someone who's, your advanced tax background come to mind when you hear something like that?
I admit that I'm not overly familiar with it, but what you're saying makes a lot of sense to me. When I think about those large stock positions, I also think about one of the things that's come into the play in the last couple of years is direct indexing. And direct indexing is a way that I can start to diversify some of those large positions, because instead of owning an S&P 500 index fund, I can basically own the S&P 500. And then there's software out there that can go and look and say, okay, here are some stocks that are losses within the S&P 500. Here's some things that perform somewhat similarly that we can replace them with, and we can start to recognize those losses over time. There are also exchange funds that you can put a large stock position into, get a more diversified stock position in return, things like that. So the principles that you're talking about sound similar. I mean, I am familiar with the 1031 exchanges. When you talk about the idea, like I had a client that had Apple stock that had 14-cent basis because it was bought 3 days after the IPO. And it's like one thing that was simple was, remember, we get the step up in basis. So as long as the position wasn't too dominant in their portfolio, you don't really want to do anything with it until after the person passes, because you're going to get that big step up in basis. And that's another way to avoid the gains tax there.
Absolutely. And by the way, if you want to learn more about how to defer capital gains taxes on the sale of public stock, cryptocurrency, businesses, real estate, you can just go to capitalgainstaxsolutions.com. It's capitalgainstaxsolutions.com. Also works for cryptocurrency. We did, before the crypto crash, about 13.5 million. We actually wrote a book about it called Building a Capital Gains Tax Exit Plan. It hit #1 bestseller. In fact, Kevin Harrington from Shark Tank's in the book, and I had him on the podcast. And if you go back and listen to some of the other episodes, he was a board member on an energy drink called Celsius. And that particular energy drink went from about 26 cents a share to like $20+ per share. And so he had a huge capital gain on that stock. And the question for him was, what, you're telling me you can defer capital gains taxes on public stock? And the answer is yes, you can. You can learn more about that by going to capitalgainstaxsolutions.com. That's capitalgainstaxsolutions.com.